Hello guys, and welcome to lesson 6. Okay, so I'm still your guy, Prof. And in today's lesson, we are going to be looking at leverage and margin. Leverage and margin in trading. So already I made mention of leverage in lesson. I think that should be lesson 3 or lesson 4. If I'm not mistaken, that should be lesson 3, where we look at certain important terminologies in the forex business. Okay, and I told you that we will look at leverage into detail as we move on, and today we are doing that. So let me quote something I said before in that particular lesson. I told you leverage is a double-edged sword. It can increase your profit as well as it decreasing as well as it increasing your losses. Sorry, it can increase your profit as well as increase your losses. So you have to take notice of that and then be cautious of leverage trading. Now let's take a deeper look at leverage in trading. But before I do that, I want to remind you that this free SMC trading course is proudly sponsored by Accurate Pips and Deriv. So if you don't know what Deriv is a broker that is multi-purpose, multifunctional. Okay, it allows you to trade different ranges of instruments, currencies, indices, metals, commodities. Then also have the options. That is those of you that do options trading. Deriv also have that for you. So you have the ability to trade options, you have the ability to trade currencies, indices, and synthetics like boom, crash, volatility 75, 100, and so on and so forth. So without much saying, if you want to create an account or sign up with Deriv, I will leave a link in the description of this video. Do well to click on the link to sign up with that link for awesome opportunities in the market. If this is your first time on Accurate Pips YouTube channel, do well to subscribe to the channel and don't forget to turn on the bell notification icon so that you will be notified of our subsequent uploads. Now, let's get into the lesson. So leverage is just money that the broker is borrowing you to trade with. All right. So we have our own money, but our money is not enough to trade with. So what happens is when you use leverage, it means that the broker is going to borrow a certain amount of money based on a ratio. Okay, so leverage is a ratio. So based on that ratio, that will give you your position size. Okay, all right. Now let's look at a textbook definition of what leverage is. Leverage is you having the ability to control a large amount of money using none or very little of your own money and borrowing the rest. So as I said before, this is a money that is borrowed to you by the broker. So it's not your personal money, it's just a money that the broker is borrowing you to use for your trading. Okay, so it's either you make a little amount of deposit and then you trade with, but there are also brokers that give what we call welcome deposit bonus. Okay, that's a sign up bonus that you can use to trade. They have terms and conditions, okay, that you can use to trade as well. Now let me give an example here. So let's say you want to control $100, $100,000 position. Okay, now you want to control $100,000 position. The broker you are using will set aside $1,000. Okay, once you want to control this amount of position, it means your broker is going to set aside $1,000. All right, $1,000. All right, from your trading account. In this case, your leverage ratio is 1000:1. All right. So 1000 is to 1. Are you with me, guys? So what is happening here is that you are going to be what? You are going to deposit $1,000. That is the $1,000 set aside is your personal money, okay, that you are depositing with the broker as a collateral. Then the broker will now borrow you a ratio of 1000:1. Okay, so $1,000 multiplied by your $1,000 will give you a position size of $100,000. All right. Now we have different this thing. So for this one, the ratio is 1000 is to 1. Okay, so that is the ratio we are using. For instance, if you want to control a $10,000 account, it means your broker will require you to what? To set aside $100. Okay, so you make a deposit of $100. So in this case, the ratio is what? 100:1. All right. Okay. Now we have other leverage ratios, as I said. So we have 1:1, 1:2, 1:10. It means, for instance, if it is 1:2 and you are having, you want to control a position size of $200 and you are using a ratio of 1:2, then that means that you are going to be depositing $100. Okay, so 100 multiplied by 2 should give you $200, and that will be your leverage. Now 1:10, 1:50, 1:100, 1:200, 1:500, 1:1000, 1:2000, 1:10,000. We have it, okay, different ratios depending on the broker that you are using. There are brokers that don't give dynamic leverage ratios. Okay, that is, they don't give you enough leverage ratios for you to choose from yourself. So based on those brokers, it means they have a kind of a static leverage. So they will tell you, okay, this is the leverage we are looking to give you. Maybe 1:50. That's all you can deal with. You don't have a choice. You either take it or you leave it. All right. So now let's say you make a deposit of $100. Okay. Let's say you make a deposit of what? $100. All right. Now, if you are looking to use a leverage ratio of 1:1, it means that you are only going to be able to control $100 position. Okay, $100 position. So here your ratio is 1:1. All right, guys. So that is one thing that you need to what? You need to understand. That is one thing you need to understand. All right. Let's look at the next thing. That is how to calculate the leverage amount. Okay. So how do we calculate leverage? Now, you calculate leverage by multiplying your deposited amount by the ratio of the leverage. So let's say this is the ratio of this leverage, okay, 1000:1, and then you have deposited, let's say, $200. All right. What is going to happen is you will multiply this 200 by this leverage ratio, which is 1000, and that will give you what? A $200,000 account in terms of what? Leverage. Okay, in terms of leverage, you will be able to control a position size of what? $200,000. So if, let's say, here was to be $500, it means you'll be controlling a position size of $5,000. All right. Okay, so that is how simple it is to calculate your leverage. All right, so that is enough about what leverage. Okay, that is enough about leverage. In summary, let me put it this way. In summary, leverage is you doing more with what? With less. Okay, you have less money, but you are able to what? You are able to maximize your opportunity in the market. So that is simply leverage. All right, guys. Okay, so now let's look at margin. Okay, let's look at margin. Let me clear this chart and then we look at margin. All right. So what is margin? Okay, what is margin? Um Now let me put it this way. First of all, let's try and get the definition of what margin is. So let me first give us the definition of margin. All right, then I can continue with my explanation. So margin is the amount of soft cash, okay? So the digital cash that you are depositing, all right, that a trader is required to put forward in order to be able to open and maintain a position with his or her broker. All right. So the amount of soft cash that a trader needs to put forward or deposit in order to be able to open and maintain a position with his or her broker is what we refer to as what? As margin. All right. So now I'm not going to bore you too much with plenty theory. So I'm just going to be straightforward and very simple so that we can close this lesson. Now, margin is usually a portion of your capital that you deposited. This is known as a collateral. Okay, it's just like how you go to the bank to take a loan and then you use your house or your car as a collateral. It's the same thing because of leverage. Because you chose leverage trading, it means depending on the ratio of your leverage, it means the broker is borrowing you a certain amount of money, but the broker needs to set aside a collateral to be sure that when you lose, okay, a trade, you'll be able to pay with that amount. That's why you are required to make what? A deposit in your broker account. All right. Now, this is a collateral and it's a percentage of the size of the forex position. A percentage of the size of your forex position. Now, this vary from broker to broker. As I said, every broker has its own margin level. Okay. Now, this thing called margin is not a fee, nor is it a transaction cost. Okay. For instance, let me give you an example of what I mean. Let's say in forex, you want to let's say trade $100,000 position on, let's say, USD NZD. Okay, USD NZD. Now, if you were in the live class, you understand what I'm trying to explain here. If you are not, you can repeat the video or you can repeat this session over and over again. Okay. So if you want to control $100,000 position, as we look at under leverage, okay, your broker will set aside $1,000. Okay, so you are looking to control $100,000 what position. Your broker is going to require you to what? To deposit $1,000. That is what they will set aside in order to be able to give you this ratio of what? Leverage. That is 1,000:1 for you to be able to what? To control this what? This position in the market. All right. Good. So once this happen, okay, once this happen, it means that you'll be able to what? To trade an account size of what? Of $100,000 using what? Using how they call it? $1,000 what? Account. Okay. Using $1,000 account. All right. As I said, leverage trading is risky. So it has both its positive side and its what? Negative what? Side. All right. It has its what? Positive side, and it also has its what? Its negative side. Oh, sorry. Here, the ratio is supposed to rather be 100:1. We are having $100,000 position size, and we are making a deposit of what? Of $1,000. Okay. So here the ratio is 100:1. Okay. So when you multiply this by that, you get what? Your $100,000 position. Okay. Your $100,000 position.